The ECB just issued a dire warning about a sharp slowdown. Could this be the tipping point for Europe's economy? Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, what if everything you rely on, jobs, savings, and stability vanished overnight? The European Central Bank's terrifying new warning says that day for many Europeans could be here soon. Plus, while the market trembles and retail investors panic, our latest trade is defying gravity, soaring higher every day. Stay tuned to the end of the show to learn how our subscribers are flying high and how you can too. Now, let's head over to Bloomberg, where we picked today's story up, because we're going to start in Europe, and I'm going to show you the parallels to what's happening right here at home, because I want you to be thinking the global central bankers said they wanted to pull back on demand before they let the global economy start running. We told you it wasn't going to work. They're going to send it all crashing down. Well, as it turns out, I was right. Now, let's pick today's story up with a headline: as Eurozone wage growth cools from record, backing ECB rate cuts, as fourth quarter negotiated pay is slowed down to 4.1% after a 5.4% gain in the third quarter. And this is something we've been warning about, that we typically see wage growth accelerate going into recessions, and then it starts to pull back. What we're seeing in Europe is now following exactly what we've seen in past cycles. Let's go back to 2008. As we're heading into the global financial crisis, you can see that wage growth in Europe was rising, and then it came crumbling down. And then around 2019, as we were heading into the pandemic, the global economy was slowing down, wage growth fell, and now look what's happening. We saw a peak last quarter, and now for many Europeans, they're seeing a massive slowdown, and this is going to have huge consequences because the ECB noted a sharp slowdown. But here's the thing, we saw that in the US data today as well, because the data backs the ECB's assumption the salaries are set to rise more slowly from here after they caught up to the consumer price surge of recent years. And this is something we've heard from U.S. companies. They've been saying, look, we need to raise prices because we have to give our employees bigger wage gains, and we're going to pass these higher prices on to consumers. But there's a problem, because something happens to wage growth right before it hits inflation. We're going to look at that here in a moment, and that should eventually lead to an easing of services inflation, which has been stuck around 4% for months and is a lingering concern for policymakers. And it's a massive concern, because what did they do? They raised interest rates all over the world, and what happened? Nothing really changed. Yes, inflation slowed down, but then all of a sudden it started to turn higher. And what is telling us that this monetary policy mechanism, these central banks that are pulling the lever of raising and lower interest rates, absolutely does nothing. In the end of the day, it's all about the labor force, and for Europe, it's changing in a big way. Let's take a look at some U.S. data here, and what do we see going into recessions? You typically see inflation rising, but when we look at average hourly earnings out of production and non-supervisory employees in red, what do we see? Well, it keeps pace with that going into the late 1980s, and all of a sudden, right around 1990, you'll note that inflation continues higher and wage growth starts to decelerate. And so that's the issue we're starting to see in Europe. All of a sudden now, wage growth is slowing down. The problem is inflation has been too hot for many Europeans. They're behind, just like many Americans, and they need their wages to continue to rise so they can get caught up. The issue is when that doesn't happen, as you can see, you get this gray shaded bar. That's the 1991 recession. This happens once again going into the dot-com bubble. Inflation's rising, but wages aren't growing fast enough. All of a sudden, wage growth peaks and starts to decelerate. Inflation peaks just after it, and then it's too late. We're right into the dot-com bubble. And we see the same thing once again in the global financial crisis. Inflation rising out of control due to energy prices. It's not passed on into wage growth. This time, though, the consumer price index comes crashing down as oil prices just crumble, and that eventually leads to a deceleration in average hourly earnings. And right, of course, as we're in smack in the middle of a crisis, we see the same effect right around 2014 as wage growth slows, inflation rises, and next thing you know, inflation comes down. And here, once again, what are we starting to see in Europe? Wage growth is slowing down. Inflation still running relatively too high, but after too many years of hot inflation, what is it telling us is that Europeans are not going to be able to afford prices even if they come down a little bit, telling us that the Eurozone is headed into recession. The problem is, as you're about to see in the US data, well, we're not too far behind. We're just seeing a slightly different different way. Another reason to expect more moderation is the region's labor market is starting to soften as the economy struggles for traction. Well, if wage growth is decelerating, then demand for labor is falling. And it's very obvious because when there's more work than there are workers, wages go up to attract people into the workforce. So it's very clear. The fact that you're seeing a deceleration of wages means that there's going to be more unemployment coming from Europe. And while companies have long faced acute worker shortages, demand now for the global economy is plunging, and the situation has been normalizing. And some firms, for instance, in Germany's manufacturing sector, are even cutting staff to reduce costs. And it's not that they're cutting staff just to reduce costs. They're cutting staff because they don't have the demand. And we continue to see this in the PMI data that's telling us very clearly that there aren't enough new orders to sustain the workforce there in the manufacturing sector. Now, they've got a lot of backlogs they're working through, but the issue is going to come down to this. At some point, those backlogs are going to go away, and that means not only are there going to be lots of German manufacturing jobs gone, they're going to see that happen all over Europe. But one thing that should be soaring higher, that's your trading account. Check this out. As of close of business yesterday, this is our mystery trade. You want to find out what it is? Well, you've got to subscribe. Here's the best part. You can get in for free for the first 30 days. But look at this. Back on February 24th and 21st, we put out to our subscribers this note. They're up around 4% each. And here is the actual note to our subscribers. Now look, if you're watching the equity markets go down and you want to know how you can be seeing your accounts go up, grab those links in the description below. Use a coupon code for a 30-day free trial. Stay tuned to the end of the show and I'll show you exactly how they're doing it, and you can join in too. Because here's the real issue. When you see demand going down because prices are rising, as we look at the consumer price index in blue against continued unemployment claims in red, what starts to happen is you get a deceleration in wage growth against rising prices. It means people have less money to spend in the economy. So as they spend less, well, that impacts other workers who see their hours get cut, and then eventually their jobs get cut as well. And what happens next thing you know, just like what we're seeing in Europe, continued claims start to head higher. People start hitting the unemployment line. And at first, the policymakers don't worry until it spirals out of control, and then you're right into a stagflationary recession. You see that happen in 1991 here in the US. Let's look at what happened in the dot-com bubble. You see continued claims all of a sudden took off and continued higher week after week, despite the fact that inflation continued higher. Next thing you know, due to a big drop in demand because of all the people on unemployment, inflation came crashing down. So if you think about what policymakers want, they wanted to bring inflation down. And what did they really want to do? Well, they wanted to restrain demand because they said there wasn't enough supply. And we said, look, it's not going to work this way. And sure enough, we've got it right. What we're facing now, they pull back demand, and all it's going to lead to is oversupply. You see, once again, you see rising inflation with rising unemployment going to global financial crisis. Again, another stagflationary recession. What are we expecting? Prices now to go up in the United States and other parts of the world. We're also expecting unemployment to go up, particularly with a lot of government employees hitting the unemployment line. And what this is setting up is for the United States to follow Europe right into a stagflationary recession. The ECB is relying on various indicators to monitor pay growth in the region, including a tracker meant to predict future developments. And that measure continued to signal, to get this, a sharp slowdown this year when it was updated earlier this month. So what you're seeing is the headline government data, but their predictive model that looks at more real-time data is telling us there's a massive slowdown. What that means is demand is plunging in Europe, and that means not in the far distant future there's going to be a lot of Europeans hitting the unemployment line. You can see, my friends, all the recipe here for a stagflationary recession is brewing in Europe. And if you think the US is immune, well, wait till you see what we had. We also faced a sharp slowdown, just in a different way, but one that indicates the danger signs for the U.S. economy as German households pay 31% more for energy than pre-crisis. Now, I want you to think about this, because if more of your budget's going to energy, well, less of it is going into the real economy. And in view of the renewed rise in wholesale prices, higher grid costs in electricity and gas sectors, and rising CO2 prices, it's more likely that energy costs will continue to rise. So for Europe, particularly Germans who are facing higher energy prices, you're going to see their discretionary spending plunge. And perhaps that's what we're seeing in the real-time data there that's telling us that average hourly earnings are plunging throughout Europe, and for good reason, because demand is going down. It all starts to make sense. The problem is it means the Eurozone is headed squarely into a stagflationary recession. But despite that, inflation figures are cooling off as French and Italian inflation figures support the case for ECB rate cuts. Well, what they're actually supporting is demand's going down, because February prices rose 0.9% from a year ago in France, 1.7% in Italy as they decelerated. And we see that in contrast to France and Spain, prices jumped 2.9% across the region, but the ECB remains confident it will achieve its 2% goal this year, particularly as the bloc's economy struggles. Well, they admit that the economy is weakening here, and yes, they're hoping that inflation comes down, but as you've seen, it will come down because the more people you put on unemployment, demand drops. In fact, the higher energy prices go in Germany, demand will drop. And at some point, all the supply that will build up in the system, well, next thing you know, businesses will be slashing prices. They will get inflation down, but they're going to get it with a recession. Regional numbers from Germany also point to a slight easing of price pressures nationally. And while that's in line with consensus among analysts, the 2.7% reading that's foreseen would still be elevated, particularly at a time when Germans are spending more money on energy and predicted to spend more. It's going to be a lot less in their discretionary economy. You can see all the shaping here of how the economy is going right into a recession. But again, if you think the U.S. is immune, as you're going to see, it's not. Because despite all that, ECB officials deemed it safe to keep calling policy restrictive. So despite the fact that the economy is slowing, that you're seeing wage growth start to decelerate in real time and in a sharp way, on top of that, they're seeing price pressures on utilities for Germans. They think, well, policy is still restrictive, but yet members concurred that the disinflationary process was well on track while the growth outlook continued to be weak. So what they're saying is, look, we're going to bring inflation down, but at the sacrifice of the entire Eurozone economy. So I want you to see, my friends, what these policymakers do, because there's a reason why. Every time the central bankers start monkeying with monetary policy in the economy eventually goes into a recession. This time, everyone believes that the Fed's got it right, but as you're going to see, they've got it completely wrong. Risk to growth outlook remain tilted to the downside, which typically also implies downside risk to inflation over longer horizons. So you've got it. That's exactly what we've been showing you in the charts, that when you enter a stagflationary recession, growth and inflation expectations come crumbling down. Despite all that, the ECB still has policy rates in a restrictive territory. But now let's turn to the United States, where we also saw a sharp slowdown. But despite the fact we did that, a lot of experts just don't get it. As U.S. spending drops in cold weather, an inflation gauge offers some relief to many Americans. Inflation-adjusted consumer spending fell 0.5%, marking the biggest monthly decline in almost 4 years after a robust holiday season. The drop in outlays was driven by an outsized decline in motor vehicle purchases and drops in categories like recreational goods. Now, we predicted that this was likely to happen, and now we're seeing it. We said that a lot of consumers were going to go out and spend big at the end of the year to front-run tariffs. They did that. We said in the beginning of the year their spending was going to drop off in a big way. But look what the experts had to say. Consumers took a breather in January. The key question is whether this is the onset of a more cautious consumer in 2025. No, it's the sign of a consumer who's tapped out financially, who is worried about the jobs market, who cannot afford higher prices, and now is taking on a whole lot of debt at the end of the year to front-run tariffs, and now is seeing their credit card levels at record high amidst very high interest rates. And on top of all that, insurance costs are still going up. And let's see what's likely coming for U.S. workers, and that is going to be a massive decline in demand, because now when we take a look at real retail sales, that's inflation adjusted in blue, against average weekly hours of production and non-supervisory employees in red, what do we see? Very clear signs that as weekly hours decline, real retail sales decline with it. And so you see, once again, going to the global financial crisis, that hours worked remained steady, and then they started to drop, and that was the nail in the coffin for the retail sector. Demand plunged, and look what's happening now. Just like Europe, who saw a big drop in average hourly earnings, here in the U.S., we saw a big drop of average weekly hours, not to mention that translated right into a drop in spending, and that will eventually catch up to the government data. And so you're seeing the same things, the same sharp drop that's happening in Europe is happening here in the United States. The so-called core personal consumption expenditures price index, which excludes food and energy items, rose 0.3% from December from a year ago and increased 2.6%, matching the smallest annual increase since early 2021. And despite the fact that it's the smallest annual increase, consumers still cannot afford prices at where they're at. That's the problem. Household budgets are strained in a major way, and we're seeing consumers start to worry that the labor market is the next to go. The PCE report showed a 0.9% increase in nominal incomes in January, thanks in part to an annual cost of living adjustment for Social Security beneficiaries. Inflation-adjusted disposable personal income in time rose 0.6%, helped pushing the savings rate to the highest level since June. So wait a minute. So incomes went surging higher. At the same time, spending plunged. And this is very important to understand because this is a big sign for the economy. What it's telling us is that consumers are indeed worried about the economy. They're worried about the jobs market, and that's what we're seeing in the sentiment surveys from the University of Michigan and the Conference Board. And when people start worrying about losing their jobs, there's a couple of things they do. They cut their spending, they start paying down their debt, and they increase their savings. And this is not a good sign, as you're about to see, for the direction of the economy, because it has a major impact on spending. Because when we now overlay real retail sales with the personal savings rate, it becomes very clear that back in 1999, consumers were starting to worry about the economy. They increased their savings rate, and what happened? Retail sales came down. They see that happen once again going the global financial crisis. You can see that real retail sales started to plunge at the same time that the personal savings rate soared. And let's look at what happened in 2022. The personal savings rate surged higher. Retail sales came crumbling down, and now what are we seeing signs of? Personal savings rate headed higher. That means retail sales likely to head significantly lower in the months to come. So when we look forward to demand for 2025, consumers aren't taking a breather. They're calling the game and heading to the sidelines. As Friday's numbers show, growth in services spending, which accounts for a bulk of personal consumption outlays, was also tepid last month. Meanwhile, spending on utilities got a boost amid colder weather. So just like what we're seeing in Germany, U.S. consumers faced higher energy costs. It means less money is going to get spent on the discretionary side of the economy. So as we started to show out, the ECB warned of a sharp slowdown. Well, in U.S. here, we have the same sharp slowdown, just in a different way. And what it's telling us that not only is Europe headed into stagflationary recession, but the U.S. is soon to follow. But something that should be surging higher, that's your trading account. As check this out, is our mystery trade that went on the books for our Momentum Timer Pro subscribers back on the 21st, and then on the 24th for our CTA Timer Pro subscribers is up anywhere from 3.3 to 4%. And here was the notes that we gave our subscribers on those days, telling them this is what you want to buy. And here were the days that we said buy on these days, and it's headed higher and looking to break out. This could be our next big trade, and we've had some big ones lately. Now, how do we do this? Every day we run two reports. One, we look at machine positioning each and every day. And what are we looking for? We want to find out that when the machines need to buy, so we can position our subscribers to buy ahead of them. So when the machines come in, it sends their price going higher. And then we tell our subscribers, look, it's time to get out before the machines turn and burn. Let's call our CTA Timer Pro. Now, here's a great thing. You don't have to read the report. We tell you right underneath it every day which trades you should take. But maybe you like to trade momentum, but you find yourself getting in late, out early, and sometimes all over the place. Well, we run a proprietary overlay because just because momentum is oversold does not mean price goes higher. You need to make sure the trend is in your favor. And again, just like our CTA subscribers, we give you the notes on all the trades right below that. We make it super easy for you. You get the daily reports. You get all of the signals. I go through the signals and tell you which trades I think you should take. We have fully backtested our reports. We give you risk control levels. We update our trades every week, including my personal trades. And yes, I use the reports just like you. And on top of that, we're so confident that you can make money trading our service. We'll give you a 30-day free trial. That's right, your first month on me. Check out the links in the description below. Be sure to use a coupon code. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.